You have seen the headlines about dollar decline and currency wars. The panic selling is tempting, but it is a trap that could cost you more than just your peace of mind. This video explains why recent yen interventions signal a slow shift in global power rather than an overnight collapse, revealing the specific hidden inflation risk that comes from keeping all your savings in one basket, the US dollar. When central banks intervene to stabilize currencies like the Japanese yen, they are not merely adjusting numbers on a spreadsheet. They are signaling that the era of unilateral control over global finance is ending. For decades, we have operated under an assumption that the United States could sustain its current economic position indefinitely without consequence. Recent actions suggest this stability was never guaranteed. The market does not care about your emotional reaction to these shifts. It cares about where capital flows when confidence wavers. To understand why this matters for your personal balance sheet, we must look at a warning that has been on the books since the year 2000. Back then, economic analysis from the International Monetary Fund highlighted a critical threshold regarding U.S. deficits. The data showed that relying on continuous capital inflows to finance our consumption is not an infinite resource. When foreign investors begin viewing American assets as too large a share of their global portfolios, demand for dollar-denominated debt naturally drops. This triggers a fundamental adjustment in how value moves through the system. The specific numbers from those historical projections are stark and instructive. To stabilize the economy during previous peaks where deficits became unsustainable, export growth needed to be double the rate seen in the 1990s. In that decade, exports averaged roughly 7.5% annually. A stabilization would require doubling that pace. Simultaneously, import growth had to be cut significantly, moving from an 11% annual increase down to approximately 5.5% just to restore balance. Quick resource note, I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. These figures are not abstract statistics for economists in suits. They represent the friction points where global trade flows become constrained. When the system requires such drastic adjustments, it implies that structural shifts are inevitable without adaptation. The current yen intervention is an early indicator of this recalibration process beginning again, though perhaps at a slower pace than panic suggests. It confirms that no single currency can sustain absolute dominance forever without creating friction in the global economy. This brings us to the most dangerous risk for individual households: hidden inflation. Most people look at their bank statements and see a static number or even growth in nominal terms. They feel secure because the balance is rising, perhaps aided by interest rates that have recently climbed. However, this security is an illusion if your entire net worth is tied exclusively to U.S. stocks, bonds, or cash accounts. You are effectively holding a single asset class, the dollar itself. When the global system shifts and the reserve currency status weakens relative to other assets or foreign currencies, prices rise even if your bank balance remains perfectly stable. This creates an invisible erosion of purchasing power over time. Your savings account is losing money every day you leave it there without a hedge against this shift. The danger is not that your dollars will suddenly become worthless paper. The danger is that they will buy significantly less than what they purchased 5 or 10 years ago, even while interest rates fluctuate around them. The solution to this risk is often misunderstood by viewers looking for quick fixes in volatile markets. You do not need to go on a run to buy gold or sell your retirement accounts at the first sign of trouble. Speculative bets on commodities are rarely the right tool for long-term wealth preservation, especially when you lack deep expertise in those specific assets. Instead, the strategy requires a structural change in how you view asset allocation. The goal is building resilience by ensuring that if one currency weakens, other parts of your portfolio can buffer the blow to your purchasing power. This means moving beyond simple diversification into equities and cash holdings denominated only in dollars. You must consider international assets or instruments not tied solely to U.S. monetary policy. The objective is a framework where you are no longer betting that one currency will remain strong forever against a shifting global landscape. In previous cycles of unsustainable deficits, the market demanded structural adjustments like doubling export growth and halving import rates just to stabilize the system. These were painful transitions for economies as they recalibrated their external balances. For you today, the transition is about recognizing that your current saving strategy carries hidden inflation risk. By relying on a single strong dollar without diversification, you are exposing yourself to forces outside of your control. The signal from recent interventions is not a call to panic sell or flee into speculative assets. It is evidence that the dominance we relied upon for decades is slowly fracturing, requiring us to adjust our personal risk models accordingly. The most prudent move is calm and structural. Diversify beyond just domestic stocks and dollar-denominated cash. This approach protects what you have earned from long-term currency shifts rather than trying to time short-term market noise or reacting to fear-based clickbait. By acknowledging that the reserve status of the dollar is not what it used to be, you can make informed decisions about where your money works hardest for you over decades. The path forward is not about predicting which country will rise next in global dominance. It is about ensuring your personal financial foundation remains solid regardless of how those geopolitical tides shift beneath you. Stop reacting with fear and start building a portfolio designed to withstand the inevitable changes coming from the top down. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.